like. So this lecture, I'm going to give you an overview. So once you leave here, you have an idea of what you're going to learn during this course. And maybe you're going to follow the rest of this course. The next lecture is DCF company valuation. So Hans Hanepel is coming here. He's going to give you a lecture, everything you have to know about DCF value, discounted cash flow valuation. So if you want a company in the way that it's currently applied, for instance by private equity, he will teach you that. And in the end, he will give you an assignment, and he will discuss this assignment online. So there will be either you can follow it live or on a video. You can see how this valuation assignment works. So then you know DCF valuation. Then, week 3, preparation week. There's no courses if you're back, because what I don't want you to do is wait with reading and looking at the videos just before the exam, and then just do everything at 3 times the speed and then do the exam. So I give you a preparation week in week 3. There will be no courses, but make sure that you know everything that you have done so far. Week 4, real options. That will be taught by me, because I'm completely freak about it. So it doesn't have to mean that you're freak about it, actually. So I will give the real options lecture, and there will be tutorials in different smaller groups where you can make assignments at the end of the week. And lecture 5 will be the game theory section. Joris Skill will come here. So I will be here, but Joris Skill will come here, and he's working at a port fund, so a venture capitalist, and he will show you how behavioral decisions and game theory decisions affect his decision-making process. And at the end of the week, there will be 4 groups of tutorials by Lauren. And week 6, lecture 6, we have a guest lecture by someone who's working in private equity, and he's going to talk about his big deals. But it is inspiring. So at the end, you can see, okay, how is it currently done, and is this maybe something for me? Here we go. Exam and grade. Closed book exam. Required literature, so I make sure that everything, that all the questions is also on Canvas. All the questions, the material of the questions are on Canvas online, so you can access all the questions. I'm not going to ask something new that's not there. We have, the exam is typically always the same. There's 4 questions in total. 1 strategy question, that's actually this section. 1 DCF question, a very big one. That's next week. 1 real option questions and 1 option game question. So just the different components, 1 question each. DCF is a little bit bigger than the others. See Canvas or send online for the exam. We're going to look at in acquisitions. So if you look at acquisitions, or maybe even if you look at valuation on financial markets, we see values that seem exceedingly high. And if you look also at the literature in finance, so the literature on acquisition, so when companies are bought, on the prices they are paid, the premiums are really high. So there are different strands of literature that try to explain it. And one of them are rational explanations, so we're going to do that. So maybe what the company is going to do in the future, that rationalizes the value to some extent. It can still be higher, even if the firm has growth opportunities. And there can also be irrational explanations. Price exceeds the expected value. And we're going to do some thought experiments there. So we're going to see how sophisticated you might think about value, or how sophisticated you might think about how others value an item that's being sold. How does this work, this valuation and this perception of value? I have this following small visual experiment, actually. And we're here in the subway, and on top of this picture, there are 2 lines, 2 red lines. This red line and this red line on top of this picture. Are you super smart students? You already might think where this would go, but maybe you can just raise your hand. Who thinks that this one is smaller? Nobody? Who thinks that this one is taller than this one? Yeah, some people. And what do most of you think? Well, I give somebody the honor to say it. You can say it because I heard already. Same. They are exactly the same. But you agree with me that for everybody, and I'm sure about that, this one seems smaller than this one. But they are exactly the same. So the size of this one is, if I move this one to this one, you will see that it is exactly the same. How does this happen? Well, obviously, this perspective determines our vision of how long this line is. And this is if something so reliable as your eyes can be fooled. So your eyes, you can really trust your eyes. You use them every day. If your eyes can be fooled, and everybody thinks that this one is taller. Everybody sees that this one is taller. Think about when you have to value a firm, or when you have to make an investment decision. And everybody is screaming, and look, this internet bubble, this internet is the new thing that is going to be hugely valuable. If everybody is shouting that around you, you might also be influenced by how valuable you think it is. And we're going to do some experiments in this actually today in the next hour. So what are we going to do? I'm going to show you how to link the corporate strategy to market value. Please note, please look every week at the videos. And after this you will be familiar with, after this module, so after today, you will be familiar with strategic paradigms and able to link the valuation to an expanded MPV criterion that captures cash flows, but also future opportunities and the strategic value of a company. I'm going to give you a short break, and we're back in 15 minutes. Ja, goed.
Ik moet er nog steeds voor betalen. Ik sta niet zo goed.
Moet je het certificaat uitzetten?
Certificaat uitzetten?
Oh, graag worden.
Okay. Would like to start with the second lecture. So, okay. Would like to start with the second lecture, please. So, linking the market value to the strategy of the firm. Let's go. So linking the market value to the strategy of the firm, an expanded net present value criterion. So if you look at the market value of firm, so if you look at, for instance, for traded firms, you see sometimes this is a spike during a 2000 bubble. You see tremendous spikes. So how do you link the value of firms to the strategy? So obviously, the value of a firm is what it's going to do in the future. Sometimes their assets are already there. But often, also value is assigned what the firm is going to do. So if you look at the market value of the firm, we can subdivide it in a part that represent the present value of assets that are already in place. So that's the present value of assets. So that is the cash flows of assets that are currently there. So for instance, if you would value let's take like Tesla, for instance. If you would value Tesla, they currently sell shares. They currently sell cars. So and they have some energy and some services. So the present value of these cash flows, the asset, the present value is currently there. But they want to do more. So they also have future growth opportunities. For instance, maybe they want to have like a robot taxi service, for instance, which would generate a lot of cash flows. They don't have it yet, but they plan to do it. And that is then a future option or a future growth opportunity. And also some strategic component is in there. Because how well can they do that? Are there any rivals who can do the same thing? And if rivals can do the same thing, you're all economists. What happens with the prices? They both expand scale, and prices go down until everybody earns the opportunity cost of capital. So you have to have some competitive advantage or strategic advantage. And that's especially important for stuff that you are going to do. Because if assets are already there, the fact that the assets are there is already, that has some commitment value. But things that you're going to do in the future, you have to look if somebody else is not going to do it better. Obviously, this growth option value depends on the strategic position of the firm and its adaptive capability. So how well can the firm adapt, maybe use new technologies, AI, artificial intelligence technologies, to create these future growth opportunities. So depending on how the world evolves, you try to capture that. And there are techniques to value it. So from assets that are currently there, that generate cash flows, we have discounted cash flow analysis. So if a factory is already there, it generates operational cash flows in the future. For the next 20 years, you discount it backwards to now, and you have the present value. If you have like distinct opportunities, you can look at growth option value. For instance, if there's an opportunity to develop a new product, a robot taxi or even a robot, you can try to value that with reoption valuation technology. And everything in the future is obviously uncertain. Option technique is a method that really deals well with uncertainty. And finally, the strategic position of the firm is very important to appropriate these growth opportunities. For instance, ASML, as a Dutch company, they have this technology. What they do is they make the machines for the producers of chips. And they have this lithography technology that nobody else can replicate. So if you can do that, you can make the smallest chips ever. You can provide the machines for the smallest chips. You have actually a monopoly position, and you can determine the prices. And also you see that reflected in the market value of this company, ASML. So the learning objective is today is understanding and measuring growth option value. And measuring growth option value for traded firms is actually super simple. And I invite you to do it yourself. So once after this lecture, you go to Google Finance, and why don't you value some of these growth opportunities that the market assigns to different firms? That's the left column. And also want to help you today to help you understand what drives this growth option value. So why do you have some firms growth options and the other firms haven't? So what is the underlying value drivers of these growth options? And I hope to show you some case applications to illustrate it. Measuring growth option value. Measuring growth option value is quite simple. There's also a video online. you look at the equity value of the firm. An equity value is obviously known from financial markets. So you take the number of outstanding shares and multiply it times the price, and then we have the equity value in financial markets. The second part is the value of assets in place, and we just learned that there's a present value calculation. So you can calculate the present value of earnings as an annuity generated by the assets that are currently in place. So you capture actually the cash flow value, the profit generation value of assets that are currently there. This is quite easy. Everybody can do it here. It's just a discounted cash flow calculation. And if you do it into eternity, it's an annuity. Very simple. You can observe this one, equity value. You can calculate, very simple, the assets in place. Then you know what the PVGO is because you can back solve it. So if you know the market value firms, and you can back solve, and you can then know the value of earnings, so stuff that is stuff that can be explained by the earnings that the company have in its current assets, then you can back solve actually the stuff that is difficult to value, and that's the present value of the growth opportunities. And that's what the firm is going to do in the future. Or what the market assigns that what the firm is going to do in the future. You can do it for a lot of companies. We did it for different industries. And what we did here is calculate in this way the present value of the growth opportunities divided by the price, using different discount rates. It's not very important, so we use the different discount rates to calculate assets in place, and then we back out the PVO and take it as a percentage of the company price. And if you look there in the high-tech industries, and this is a long time ago, you see that the same industries are still have high growth opportunities. So if you look then, by then in pharmaceuticals and still in information technology, 84% of the market values could be assigned to the growth opportunities, and 16% over here to the value of assets in place. And if you go to a lot more income industries, like transportation, electric power, and chemicals, but it's changing a little bit, you see a lot less is assigned to the future growth opportunities, and much more is assigned to the value of assets in place. Does anybody know what the value is of an option in respect to uncertainty? So if you think about what the firm is going to do in the future, that is option value. You can see that as real option value. You can see PVGO as a portfolio of options. So what is the relation of options with volatility? Come on. Oh, economist. Yes? No. No. What is the relation of volatility in respect to option value? Yes, exactly. Higher volatility, higher price of the option, which is interesting. Because growth options, growth opportunities, get value under uncertainty. How do you understand? Growth options get value under uncertainty. Just like a financial option gets higher value at higher volatility. And that's because where opportunity is, lies bigger chances. So an option can be very valuable if there is a chance on a very high payoff. And if it doesn't work out, it doesn't work out. And then your value is only zero. And you see that's back here. So if you look at the volatility of these firms, with a lot of growth opportunities, you see that the volatility is also higher. So that, for instance, in information technology and pharmaceuticals, there's extreme volatility, but there also are high growth opportunities. So you can develop a new medicine that would be hugely valuable if you have a chance on developing, for instance, solve Alzheimer's disease or help solve Alzheimer's or other big diseases. It's hugely valuable. It's highly uncertain. Also in information technology, you want to go have your opportunities where there's most uncertainty and also the most chances of breakthrough. And you can see this empirically. I have a thought experiment. Because there's a catch in if you do it. If you value growth opportunities like this, there is a catch. And I would like to invite you in the following thought experiment. So please write out a number between 0 and 100, such that your guess will be as close as possible to 2/3 of the average guess. For example, if you were not with 250, but you only were with 5 people here, and your guesses were 67, 55, 50, 45, and 33, the average of that would be 50, and 2/3 of that would be 33. So the person guessing 33 would win. So what I would like to invite you, I'm going to see who is going to have the closest of this whole group. So there's some honor to guess. What is 2/3 of the average of this group? So go to Menti, please. Menti 34769157. Is that still the case? Is this Menti still correct? The technology is killing me today. Let's see. So 34986512. 34986512. give you 5 minutes. Is this working? Okay. Okay, we do it later. We do it central later. Okay. If you know the game, you can finish it, but okay. How sophisticated might one think? So everybody fill it in, or you can still fill it in while I'm doing this. How sophisticated might one think about this game? So you can say, okay, you have like below zero level of thinking, and below zero level, who has higher than 67? Okay, good. Because if you have higher than 67, you need a drink, and later come back. Because if everybody fills in 100, and I take 2/3 of that, you're always lower than 67. So thank God we have no below zero level of thinking. And then we have zero level of thinking. And zero level of thinking is, I don't give, let me find a word. I don't care about what Professor Smith is saying. Nobody cares. I take the average number here. It's all random, so I take 50. That's just the average. And then you have the first level of thinking. And the first level of thinking is that, okay, everybody's here random, but I'm smart. I take 2/3 of 50, and that's 2/3 of 50, and that's 33. So everybody's guessing 50. I take 2/3 of that. That's 33. And then the second level of thinking. Most of my students are super smart. Most of my students are super smart, so they will go 33. But I'm one level smarter, 22. And then the third level of thinking. Most people realize where this is going. They understand a little bit of game theory. So they will guess 22. So I should guess about 15. And too much thinking. Too much thinking. I don't know. Have you seen the movie A Beautiful Mind? About John Nash? So John Nash has an equilibrium, and it's I think what you think, what I think, what you think, what I think, what you think, what I think, what you think. And then it would be 0, or if I have fractions, or if I allow fractions, and otherwise it would have been 1. That would be the equilibrium. That's not gonna, sorry for Mr. Nash, that's not going to happen here. Because that's too much thinking. If you want to do that, come with me, we'll do a PhD for you and do some theoretical work. But it's not going to happen here. The 2/3 of the average is going to be the Nash equilibrium. That's too far. Actually, I'm quite curious. I also made a guess. So actually, let's see what the outcome is. Or maybe I give my guess first, who cares? So my guess is 15. So I guess that you have 2/3 of the average here is about 15. So that is a third level of thinking. But if you go to 1 or 0, then you're much too clever. And you go too far in estimating what other people think. And if you guess like 33 or higher, maybe 22, let's see what the outcome is, then you give other too few credits. And I'm going to translate it to valuation, and valuation of financial markets. But let's see what the outcome is actually. So I got it here. Somebody has a calculator. Let's see. Here. So if you could calculate it. Is somebody quick? So do 110 times 5. 30 times 15. Does anybody have a calculator for me? I assign somebody, because otherwise everybody... You have a calculator in front of you? Yeah. So can you please calculate for me? So 110 times 5. So that's the 30 times 15. 45 times 25. Do you get it? Yes. Okay. And then that amount and 2/3 of that. So why do I explain this? It's similar to, and if you have it, just shout it. Is it 30? Oh, you have already the outcome?
I put in AI, so.
Ah, cool. Let's check AI. Is it the average or 2/3 of the average?
This is 2/3 of the average.
Oh, the 2/3 of the average is, so I'm not bad with my 15, so 13. 13.2. So I'm like 1.8 off. So why is that? Why is that it's not 0 or 1? Because that's too much thinking. So the basic idea how to think about this game is think how other people are thinking. And that is not sometimes perfect. And now go back to how things are valued on financial markets. This is called the biased beauty contest of Keynes. So what you think that something is worth, or maybe the 2/3 of the average here, depends on what the average group is thinking of what is worth. And sometimes financial markets work the same way, especially as how we just calculated the PVDO. Sometimes markets work with multiples, especially if companies are extremely difficult to value. So DCF values you can reasonably value. But if you have like high-tech companies with a lot of growth opportunities and there's no relation to earnings, what happens is you're going to value them relative to each other. And that also happened here. And this is the internet bubble at a certain moment, and that's before your time. Internet came up. And it was impossible to value these internet firms because they had no cash flows. Everything was negative. So that's where the dot-com firms. But the only thing that the investment bankers could do is value related to each other with multiples. So maybe the number of subscribers to a certain of a certain firm, or maybe the total investment of a certain. So related to each other, they were pretty well valued. So related to each other, they were efficiently valued. But the whole group was mispriced, and that's what you call a common misperception. So a common perception of what the true value should be. And that could still be the case in many cases, especially if you look at growth opportunities, because the value is so elusive. And you may be a fool to pay, that's a part of a greater fool theory. You may be a fool to pay as much as you did, but you're betting that there is a greater fool down the road. And if he's right, then of course you aren't being foolish. But it's extremely dangerous to bet in a bubble on a higher value, if you cannot assign the true value of the assets that are being sold. And currently we have now also huge investments in new technology development. So this is super important to assign, okay, is this a truly valuable growth opportunity? Is this real growth option value creation, what we have here? Or is this like a common misperception? Is it overvalued? Or is there just, do we assign too much value to it on financial markets? And that is what I want to learn. And this is a behavior explanation. That's why I started with. So over here is the explanation with these two bars. If everybody is shouting, look, the average is much and much higher, the bar is much and much longer, then you also will suffer from it. Because we all have these biases. These are our biases in our fishing. And behavioral literature has shown us that over and over again we have these biases in our psychology. And these bubbles are not from now. These bubbles already happened here in the Netherlands in the 17th century with the tulip bubble. And you couldn't believe it. But for one tulip, the price of the future on one tulip on the financial market was the price of an Amsterdam canal house. Can you believe it? It's incredible. So it's somewhere in our psychology. And that's why it's usually important that you understand valuation. DCF valuation, everybody can understand. But also understand where value comes from. That's what I'm going to talk about more today. And actually assign a value to that. And you can do that with these complex techniques, like option and option games. Then you can value it instead of thinking what others think, like we did here. By the way, was there somebody who beat the professor with the 13? Should be like a group of 250 who had like close to 13. Are you? Okay, yeah, actually it was in between 10 and 15, right? Yeah. Then you say you're closer to the professor. Yeah, okay. I will have problems with you with the perusal. I can see it now already. But you can understand how important this is, right? And even great scientists, I can calculate the motions of heavenly bodies, but not the madness of people. And Isaac Newton, there was a bubble also in the South Sea. If you go into the South and you invest in that, you could not lose. And even Isaac Newton, one of the great thoughts, lost 20,000 pounds in the South Sea bubble. So that's why you need to calculate it. Calculate it. Here. It also affects other decisions. We have here a company that was Vodafone, who was in the midst of the telecom bubble. And Vodafone had a CEO, and the CEO was Sir Chris Gent. And he wanted to make Vodafone one of the biggest companies in Europe or in the world through acquisitions. And he did one thing that was actually, you can say it's smart, or he paid his acquisitions, not with cash, so you can pay acquisitions in different ways. You can pay acquisitions by emitting debt. So you take a loan and buy an acquisition, or you can pay in shares. He paid in shares. So when do you think Chris Gent did the most acquisitions? Vodafone. And the price of Vodafone is the red line, and the FTSE 100 is the line of is the index in the UK. And you see the common misperception there, the bubble or the experiment you see over here, that the price of all telecom companies were extremely high. But Vodafone especially. So when do you think he did his acquisitions? If you pay in shares, your own shares. Yes, you. Yeah, that was what you would do, and he did. So that's what acquisitions of Vodafone. And he did a very big acquisition just before the end of the bubble. But what he did was he bought overpriced shares, but his own share was even more overpriced. Just like the experiment. So he paid with overpriced shares for these new companies. So he bought all these small companies and built the companies, but at the expense actually of the old shareholders who paid too much for his deals. Again, super important to value the true value of growth opportunities. So the summary of what I try to explain now is there are not only inter-project synergies, but also synergies between different projects, but also intertemporal synergies. And intertemporal synergies, what I mean is what the firm is going to do in the future. Some firms have future growth opportunities, maybe through technology development. And this component is super elusive. You can validate one way, one simple way you can all do, I hope you do it, because you can see the market perception very easy. Go to a high-tech company, subtract the value of assets in place, that's like a DCF valuation of earnings, and the remaining aspect is the value to future growth opportunities. But there's a flaw, because markets can be mispriced. Also, like CEOs, the people who make the decisions, even you in your valuation, you can be biased, also markets can be biased. So you have to take care of market mispricing. And that's why we need more complex valuation techniques, and also ideas how we can truly understand where this value comes from. I think I'm going to give you, again, a small break before the next one. Yeah, we have 4 hours. Shall I give you again? Can we do a verse? Shall I continue or shall I... Huh? Shall I continue or do you want like a short break? You're very hard to hear. Speak out loud. Do you want a break? Who wants a break? Raise hands. No, then I continue. But that's actually very nice for me because then you're interested and maybe it can transfer some of the knowledge for you, or you just want to go home early. I don't know. Either of the two. But I continue. So what drives this future growth option value? And I promise you can go a little bit early. So we have this present value of assets in place, strategic positioning, adaptability, and competitive advantage, and these different valuation tools. These different valuation tools, DCF, you're going to learn next week, everything in and out. Also in cases where there's no real option value, especially when there's no real option value. This one is the lecture afterwards, and this one is the lecture afterwards. Now we're going to look at this. So we're going to try to understand truly the underlying drivers of this value, of the future growth option value. Can we just understand it with strategic frameworks? And if you want to understand this value, so why does Tesla maybe have growth option value? Why does Apple have growth option value? We have 2 ways to look at it. And if you want to do a valuation later on, especially if you want to do a complex valuation, you have to do both. And one way is an external view. So external view, you look externally to the industry. So you look, okay, if I'm in this industry, or if firms are in this industry, do they make a lot of money? That's just the question you ask. So is this industry structured in this way, with all kinds of frictions, entry barriers, competitive advantage, or market power that the firm can make money? That's an external way to look at it. You look externally to the firm and its environment. Or internally, within the firm. If you look internally within the firm, especially when you have like new ventures, you have to do it that way, because sometimes the market doesn't even exist. You have to look, okay, are there like unique capabilities within this firm that allows it to have valuable growth opportunities? For instance, if you look at Apple, the chances that Apple is going to, although it sees more competition now, going to have growth opportunities with the next iPhone is pretty certain, right? After the next, at which level they're iPhone 16, they're going to be 17, 18, and so forth. Although they're getting more competition now. The same thing is for technology. If you look at this company, ASML, they have like this technology. Nobody can replicate the technology. Nobody can make, even Chinese cannot make machines to make very, very small chips with the lithography technology. So then you have like an opportunity to develop this capability. Or maybe a brand name within the firm. If you're Coca-Cola, you can ask a premium because people are willing to pay for the brand. So when you look at synergies, often there are inter-project synergies. So in acquisitions, what you often see is you take one company and another company and you combine them and you do it more efficient. That is inter-project synergies. And that is always the basis for an acquisition. And they're often overestimated. But often underestimated are intertemporal synergies. So the first investment leads to the next opportunities of the next iPhone and the next opportunities. So once you go into a certain path, you create new opportunities that are extremely valuable, and it will be very hard for other companies to follow that path because they are behind. Because you're following financial economics program, hopefully you have some competitive advantage of people who don't follow this program. And hopefully if you follow this lecture, you will gain some capabilities that help you later on in your career to make better decisions, or maybe the seminar, or maybe the network that helps you create new opportunities. And these opportunities are often underestimated. And I always advise people, if you take these decisions, always go for the long term, because these inter-project synergies, these path dependencies, following this path is extremely important. And if you are ahead of this path, you have some advantage. I go through first very quickly to the external approaches. I also discuss them in the video, so I do it very, very quickly. One of the external approaches, one of the most known external approaches to look how high the cash flows could be in the market is the Porter 5 Forces framework. It looks at competition in the industry. And it's determined by potential entrants. So are there other entrants coming into the industries? Potential substitutes, the bargaining power of suppliers, and the bargaining power of customers. So let's stick to electric cars. You have, for instance, the industry competitors that are currently there. You have the traditional car makers. You have newcomers like Tesla, and also Chinese players who are coming in. And they will erode margins. You also have substitutes, maybe there are other ways of traveling, and bargaining power of suppliers. So the companies that deliver batteries and so forth, how much margin are they getting? And what is the bargaining power of customers? That also affects the prices. And that way you can justify maybe an earnings that exceeds the opportunity cost of capital or have a positive NPV. This is one external approach. Another external approach that we often use is game theory. You can also analyze with game theory an industrial organization, the complete industry. Particularly relevant if you look at pure game theory, if you have like 2 players, because then obviously you affect the other in most cases. You have Boeing versus Airbus, Coca-Cola versus rivals Unilever and Procter & Gamble. So if one lowers his prices, the other one would also lower his prices, and that affects, that influences the game. Especially if you look at acquisitions, you have often game theoretic situations where you have to bid. So if there's a company, and the company, some firm wants to buy a certain company, there's always somebody else who's interested. So who's going to acquire that company then? Well, obviously the one who may generate either synergies with assets in place or future growth opportunities. So that's very, very difficult. But there's also the game itself, the bidding game itself, because that determines the price. So the price you pay, so you have value. Value of assets in place and future growth option value. The price is not your value. That's not what you want. Because if you pay your value, if you completely pay your value, you give everything away. So you want to have the price as low as possible, obviously. And the price depends on the rivals, your competitor, your competitive bidding situations. And that are things that you can analyze actually with game theory. So you can see it in many cases, especially when you look at bidding situations or bidding contests, so multiple bidders. It's often the case, most often the case. You see that the price of a target is getting adjusted right away to the first bid and will be adjusted further on. And a very wise man, Warren Buffett, great hero, says price is what you pay, value is what you get. And price is often depending on game situation if you have to bid for somebody else. That's an experiment. Oh, sorry, I'm more on the sheet. So the total value, obviously, is the standalone value plus the synergistic opportunities. That's a buyer value, and the price, hopefully, is a bit lower, so you can create more value with your acquisition. That's what you want. Now, let's do an experiment of the influence of game theory. So let's make a small experiment here in the classroom. Where's my wallet? So I got 10 euros out of my wallet. 10 euros. That's the value of the assets. And I'm going to auction it off here, so 10 euros. So 10 euros is a firm you're going to bid for. So everybody knows what 10 euros is valuable, right? But also if you go bidding, you have often cost involved. So you have to hire Hans Hanepoel, he will be next week, he makes the valuation for you, or you can do it yourself, which is also very smart. You have to hire consultants, as your skill, who is doing the due diligence. He will be afterwards. And I always joke with them because they're super expensive guys. So there are costs involved. So what I've done now is I have the situation where there is costs, and I did it a little bit artificial. I will be auctioning off 10 euros. And the winner gets it against the price, so it will go up. But the second highest bidder also has to pay. So if you're second, you also have to pay, and that's the cost. But you don't get the 10 euros. Is it clear? So you can just raise your hand. Who's willing to just choose random, right? Who's willing to pay 1 euro for 10 euros? I got you there, yeah? Who's willing to go against him 2 euros for 10 euros? I go with you. Who's willing to pay 3 euros for 10 euros? I go with you. Who's willing to pay 4 euros for 10 euros? I go with you. Who's willing to pay 5 euros for 10 euros? I get you. Who's willing to pay 6 euros for 10 euros? You? 7 euros for 10 euros, yeah? Hey, 8 euros for 10 euros? You? 9 euros for 10 euros, yeah? You got 8 here. 10 euros for 10 euros? You take your loss of 8. 10 euros for 10 euros.
What's transaction?
Huh?
What's transaction?
Well, yeah, that is the transaction. Are you going to take your loss of 9 euros? Or are you going to bid 11 euros for 10 euros? You take your loss of 9 euros? Okay, so then, obviously, you guys went way too far. You guys went way too far, because now I'm making a lot of money, yeah, of you. So you went way too far. And I congratulate you, because normally we go much farther. And what I did was I created a game theoretic situation where you compete heavily, because I introduced costs. And cost leads to overcommitment, and you don't want to go out. So if you're going to buy your first house, watch out with making costs before you buy. So if you take your wife to it, or your girlfriend, you say, okay, where are you going to hang this? So if you make all kinds of social costs, you get committed. Oh, watch out. Same with cars. So ask the professor first, and then we get a bargain. Otherwise, don't do it. Now you're going to get me back. You want to get me back? Shall we do it again? And now for 100 euros. Shall we do it again or not? You want to do it again. Because you're now in the lecture of Professor Schmidt, and you learn a little bit game theory. So you want to do it again. Who wants to do it again? You want to do it again? Against who? And you can communicate. No, you don't get it. we do it for 10 euros again. I take you and you. You have to do it. I take you and you. You do it again. This game. But now, you're going to get to me. So I allow you to communicate for 30 seconds. Now, you and you, communicate.
We buy it for 5 euros, and we can split 5 euros.
You can do better.
We can buy it for 2 euros. I don't want to buy it. We can buy it for 2 euros, and I give it to you for 50 euros.
Sounds good.
That is the way you do it. So do you want to bid 1 euro for 10 euros? And then you can just say yes or no. Yes. Are you bidding 2 euros for 10 euros? Yes. No! Why would you do that? Do you want to bet 2 euros? Okay, then we do it again. I repeat it. Do you want to bet 2 euros for 10 euros? No, of course not. And you got it, and you make 9 euros, and you rip me off. This is collusion. Not allowed. Not allowed. Not allowed. But increasing. The first time, I organized with game theory, I tricked you into overcommitment with increasing cost. I have numerous ways to do this. I can do it with information. I can do it a number of ways, and I observe it also. I observe it anytime. And the second time, you heard me. That's collusion. Collusion hurts the seller. It's not allowed, but you can see it. Sometimes, when there is some collusional, some threat of some collusion, you can find in bidding for infrastructure in the Netherlands. So they just divided it. So instead of competing, one builder get one project and the other builder gets the other project against 2 higher margins. So you observe it as well. You can also, sorry for the Dutch, but if you're here, maybe you learn a little bit Dutch and integrate it. This is from a Dutch newspaper. Sometimes you see also big investors colluding during the bidding process and say, okay, we jointly bid. And then obviously, it's not a real collusion, but it erodes, obviously, the intensity of competition if you cooperate together. You can see it sometimes. Okay, that's for external approaches. I take 2 approaches. So Porter for industry analysis and game theory. Game theory is also interesting for industry analysis and also interesting if you look like all competitive situations, including negotiation. The other set of strategy applications that helps you understand where value comes from without truly depending on what others think, but think for yourself what the value is. That's actually what I try to say, is the resource-based view. And the resource-based view is the idea that unique resources give some advantage that other firms cannot replicate. So resources should be a source of competitive advantage, it should be relevant, it should be sustainable. So somebody else cannot come in and replicate or imitate you very easily, because then also competition comes in, so it should be sustainable, and the value of the resource should be appropriable. So some unique resources can be technical. For unique capabilities or resources can be technical. For instance, it can be the technology to make this very user-friendly iPhone that Apple can do, and also the brand name is very difficult to imitate. As I said, this EV or this technology for ultraviolet, where you can make very small chips, is a unique capability you can find. It can also be a brand name like Coca-Cola. All these resources and the leverage of these resources and capabilities allow you to earn more than the opportunity cost of capital. So it's very, very easy. If Coca-Cola wants to go to another country, it can buy all the resources. So it can buy the nice locations against market prices, but because they can put like a bottle factory there with the brand name of Coca-Cola, they can earn more than any other brand name. Same as for McDonald's. They can buy the best places in cities at market prices, because they can put a McDonald's restaurant there with their brand name and so forth. They can earn more than the opportunity cost of capital. Or a data advantage, for instance, because Tesla has a lot of data that other car manufacturers don't have with their videos. Every Tesla car can take videos that allows them to develop full self-driving. This data is very hard to replicate, and that allows them to make like this robotaxi business. And that's their future growth opportunity. And the market assigns some value to that. You also have dynamic capabilities, and actually you can best compare it actually to yourself. Dynamic capabilities, you can look at the trajectories of asset accumulation. So along your path, you accumulate different knowledge, different unique capabilities, and then you build a unique position of your company that's very difficult to replicate. And this unique position allows you to earn more than the opportunity cost of capital. So the dynamic capabilities is actually a dynamic interpretation of this resource-based view. And this resource-based view, game theory, and obviously these industry organization frameworks, they help you understand why some firms have more growth options than others, but they don't quantify it yet. And now I'm going to give you a small break of 15 minutes, and I hope you come back.
Slide 31, I think there was a typo.
Oh, thank you. Let me see.
I'm not going to say during class, but
This is better. Okay, let's keep this. If you find a typo, come to me personally. If you find something general, you can. That's very good. Nice participation. Very good for you.
I enjoy it.
What's your name?
I'm Rowan.
Good.
Nice to meet you. No, I'm enjoying the lecture. It's very nice.
Good.
It's a really good class.
I enjoy it too.
I have to charge my iPad instead, so I have to go back. Hi, I'm still not able to get the
Yeah,
access to
I don't know. So what I heard now is a lot of are able to get the first series, the first week.
Yeah.
Let me see how that works, and maybe it is the case that you have to pay. I don't know.
Yeah.
I asked them to make it for free. Maybe I can adjust something. So this is the best I can do for now.
So right now we couldn't do anything about it.
No, if you go to the next weeks,
Yeah.
it's difficult. So they didn't do. I wanted to free. I don't get any money from it. And somehow they charge for a certificate. I'm sorry.
Okay.
Sorry.
But would it influence the exam preparation?
But this should also be there. So maybe you do have to pay. I don't know. I will give a message about that then.
Okay.
If it's still, yeah, that's 42 euros. It's not for me. Sorry, I thought it was for free. I asked them for free.
Yeah.
I can see if it still can do something, but that's the case. Sorry.
Got it. Thank
Sorry.
you. Yeah.
Sorry to make you happy without being able to. Sorry.
I understand.
I will say it's century then.
Okay, thanks. I just want to know how heavy is going to be this course on game theory, because I did the game theory before and it was pretty complicated because the game were like huge and it was like even like 4x4 and it's just
Oh yeah.
it's like how deep and like how big, like how complex are going to be the
But with the new thing that we do in game theory is option games. So game theory is not very dynamic, but if you have to pay off these options deals with uncertainty and valuation. And game theory doesn't deal with valuation. Everything is like risk neutral.
But there was some mentioning in the book that there is some game theory and
Yeah,
they
that's
get to a
correct.
certain tree
Yeah.
and then I have to decide and there are certain payoffs for
Yeah.
it, and are these going to be between like two people or like many people or how
Let me put the thing off. Okay. So, okay. Of course. I think I would like to continue, please. Of course, relevance. Yeah, please come in. Okay. I had a couple of maybe some general remark. I had a couple of students who could access Coursera, but only the first week, but not the later weeks for free. So I understand that's the case. So I'm going to check it out. I don't. Yes. And then you can access everything for free. Because I really believe in free education for everybody, and I don't want to get you out of cost. So ask your fellow students if somebody here fixed it. Thank you very much. Smart guy. What's your name? Good. And he's the expert. Okay, ask him. It's possible. I try some other ways, and otherwise you have to pay 42. But it should not be necessary. But even 42, guys, all the lessons you learn, it's way positive MPV. I looked at this. I thought, okay, how can I make it clear to you why this is so relevant? And then I just Googled crazy valuation Tesla. So let's look at the crazy.
How crazy is Tesla's current valuation? Over the last year, Tesla's valuation increased from $86 billion to over $660 billion. That is an increase of 768% year-on-year.
Still, guys.
Tesla now exceeds the value of Toyota, Volkswagen, Daimler, General Motors, BMW, Honda, Ford, and Fiat Chrysler combined. But let me put this in perspective. Tesla sold 367,000 vehicles in 2019, compared to over 44 million vehicles sold by all these companies. The annual revenue generated was $20.2 billion, compared to $1.3 trillion for all these companies. On top of that, Tesla only turned consistently profitable in the last year, generating $556 million of profit compared to $29.3 billion of combined profits for the same peer group. However, despite being a relatively small auto manufacturer, Tesla's value is almost equal to that of the entire established auto industry. Now that's crazy.
So, it's full of this kind of remark, and this is actually the essence. I'm not saying that Tesla is good, I'm not saying Tesla is bad, I'm not saying it's over or undervalued, I have an opinion on that, but I don't share. But I want you to learn to apply these tools myself, that's my goal. So I want you to apply such tools to understand valuations, and some people call them crazy valuations, other people call them future growth prospects of these companies, and if they're justified or not. So behavioral approaches, like the experiment we did, say they might be highly overvalued, look how crazy it is. Well, other approaches might say, no, there is some rationale to that. I found some interesting videos of colleagues. One of them is at Morgan Stanley, Adam Jonas. Adam Jonas is leading the investment team in Morgan Stanley. Let's see what he has to say about this. It's very closely to what we're doing, actually.
How long before I see results with Tai Chi?
Day 3
if you want to do Tai Chi, it's also possible.
Day 28. With a manual transmission, steering wheel having hoopty in the garage.
Oh, wait a minute, this is too late. Here. Let's start with the mode of Tesla.
Wrapped around your body like an immersive IMAX screen, covered in carbon fiber reinforced plastic, attached to an electronic escape.
Why is it not on the board? Try again.
Driven by a supercomputer. Apple doesn't want to make a car. They want to turn your car into a mobile Apple store. We're often asked, what is Tesla's secret sauce? What's their moat? Well, it's not really one thing, but the combination of 6 attributes that set Tesla apart from its peers. Let's look at each of them. Data. 7 million cars on the road today, over 100 million by 2040. Robotics. In-house electric motors and actuators. Just the hands of the Optimus have 22 degrees of freedom. Energy. Leading battery storage solutions at scale. AI. A world-class AI team developing FSD, Dojo, and custom silicon. Manufacturing. The most vertically integrated U.S. local-sourced auto company in the world. Space. Redundant, resilient, cyber-secure comms. SpaceX is the transport layer, the connective tissue of the AI ecosystem. So, out of Tesla's dreams, what does Elon Musk think is the single most critical component of the company's moat? Without any doubt, manufacturing. You need to make the probes to collect the data, to improve the probes, to collect more data, to improve the probes. You get the idea here. Data defines the software defines the hardware defines the manufacturing. Elon Musk has used the car industry as a laboratory to develop competency in other areas. The car is to Tesla what the book was to Amazon. There are 1.2 billion cars on Earth, traveling around 12 trillion miles per year. That's 2 light years annually, roughly the distance between the Earth and the Sun 130,000 times. With an average occupancy of 1.5 passengers per car and 25 miles an hour, that's 720 billion hours of passenger time, or 82 million years. Humans spend 82 million years of time inside cars every year. 82 million years ago was the late Cretaceous period at the end of the Mesozoic era. The height of the dinosaurs, the Earth looked like this. Bees were pollinating the first flowering plants at the end of the Mesozoic era. Bees. Now, what's the value of an hour of your time? Well, it depends who you ask, but 720 billion hours times anything is a very large number. Then there's safety. With traffic fatalities still on the rise, it seems we're getting dumber faster than the cars are getting smarter. For those of you with a manual transmission, steering wheel having hoopty in the garage, don't sell it. These babies will be cherished by collectors as artisanal classics from an era when humans made the machines and operated the machines. And we still get asked why Ferrari trades at 50 times PE.
Wist je dat banken jouw spaargeld gebruiken?
Let's stop anyway.
The next time you're flying in an airplane on a clear day, take a look down at the Earth. Notice all the roads, the parking lots. See how much of our planet's surface area voted to...
Sticky fingers. So, this was Adam Jonas of Morgan Stanley. You see where he's going at, right? He talked about competencies. That's the first video I showed. They said, okay, Tesla is a car company. Look how crazy its valuation is. And the second video of Adam Jonas and Morgan Stanley, he says, no, look, this company does something else. They create core competencies, like unique capabilities. How? With data. Because they use the cars to get data to make self-driving cars, and that creates future opportunities. What I want you to understand, use your strategic frameworks to see how much this is true, and use your quantitative frameworks to calculate how valuable it is. And then you can see if something is over or undervalued. Obviously, it has some value. Is this value justified? I don't know. Figure it out for yourself. I can also show you something from the news. Let's see if that's also about the same subject, and it talks about Tesla's options. Let's see if I can get that one on. Maybe I should do it here. Technology doesn't give me a break. Where are you?
Batch of upbeat news driving sentiment on Wall Street, including a note from Morgan Stanley's Adam Jonas. Props to Money and Tears with the details. And we were talking a little bit about this note earlier, but it's very interesting that he looks at this company, and I guess he has for a while, as bigger than just cars.
Yeah, beyond an auto company is what he's sort of saying. There's a way to derive his bull case, I guess, for the shares of the company next year in 2024. Looking at the things that are non-auto, non-core, what he says.
He's an investor, this guy. So they try to explain the market value.
For their supercharger network, which they're using legacy OEMs for, that sort of thing.
And how much was also the bullishness there? Because this has been also in part, he's looking at rivals who are kind of pushing out these EV-related investments and saying, okay, that's runway for Elon Musk.
Right, as the legacy guys pull back, gives you an opportunity to push in and spend more, gain more market share in those Tesla car adjacent stuff, right? Software, supercomputing, and the EV infrastructure stuff, like the charging networks we're talking about. That's sort of a big deal there. But I just want to note that it's funny because it's not funny, but it's his model for 2030 and beyond includes these services as being a huge factor in Tesla's profitability and revenue growth there. So it's something that we've seen other bulls like Dan and I talk about that as well.
So. Okay, so you see clearly there's discussion there, also discussion in the marketplace. So how does this market cap be so can be so humongous? For you, I want you to think about, look at the news and look at these market. Think about these frameworks. So how can this be justified with the competences that are there, and how can you value it? How can you quantify that? And I hope you give you the tools that give you some insight in this, because that's hugely relevant, obviously. I have another case application. It's a case application in mining. So this is a mining firm. I have a question for you. So I got here a table. This is actually from the exam. I have different mining firms. Falconbridge, that was the one under acquisition. You have Inco, Tecominco, Rio Tinto, BHP Billiton. We have the market value of equity ranging from 11 billion to 141 billion. The cost of equity. Then you have three ways to calculate the earnings of assets in place. You have the net earnings, the EBS forecasted earnings, and the forecasted earnings in 2007. This analysis was done in 2004. And then you have the value of assets in place. So the value of assets in place for Inco ranged from 7.7 to 11 billion, for Tecominco 9 to 13 billion, 52 to 66 billion, and 80 to 100 billion. So this is the range from assets in place. Obviously, you don't know it for sure, so you have a range there too. How you exactly estimate it is not that important, but you can calculate the PVDO as percentage of the stock price. And you get here, forget the top one, you get here 1 to 30% for the smaller firms and 24 to 31% PVDO for larger firms. You can observe that. Then I have a question for you. Which of the following statements is true? I go back, but see if you can see it, if you have some intuition here. The table provides a rationale for restructuring strategy where the investor can acquire a large mining company, restructure it, and sell it to smaller firms. That's called the Raider strategy. That happens a lot. So you buy a firm, cut it to pieces, and sell it. Or the table provides a rationale for an acquisition strategy where the company can combine smaller mining firms into a larger company and gain from re-rating in financial markets. So buy big, cut in pieces, or buy small and make big. Yes? Why? Actually, yeah, I think you're right. So if you look at the small ones, you have the small ones that have a low appreciation of growth opportunities, right? You see there 1 to 32% and 7 to 36%. So if you put the smaller firms together, Inco, Tecominco, you can get a big firm, but the growth opportunities are likely to increase according to this table. Can you find a rationale for it? So the question, the answer is right. You take the smaller ones because of their low appreciation to growth opportunities, and you make a big one because of their high appreciation of growth opportunities. Can somebody has a rationale why larger firms have more growth opportunities? Yes. Synergies? Yes. What kind of synergies? Internal synergies, yes.
And external synergies because of size.
It's a little bit general. Can you find some concrete examples? Yes.
Like the overhead, you can take the overhead of smaller firms.
Yeah. Yeah. Okay, the overhead, what you say is assets in place. So if it's assets in place, get more efficient. But why does it get more growth opportunities? Yes.
Because essentially you can decrease your costs and you have more revenue opportunities to invest in other opportunities.
Yeah, other opportunities. Anyone else? Yes.
Have more experience identifying the resources or resource protection.
Yeah. Also, is very close. Yes.
Economies of scale.
Yes. Yeah, economies of scale. But how can you combine economies of scale with growth opportunities? Because what you're going to do in the future. The answer is well, quite general. Can you say it more concrete? Economies of scale and growth opportunities. Well, these mining firms that are huge infrastructure projects. So if you have these mines, they have huge investments in these enormous trucks. So scale matters enormously. So if you have a mining firm, the big ones, they have access to opportunities that are too big for smaller firms. And that's why they have higher value of growth opportunities. Also appreciated in the financial markets. Because they're big enough to take on these big projects and they have the capital to do it. If you do a strategy similar to buy and build, you take all these small ones and you make a big firm. And once you have this big firm, you also have access to the new opportunities. And then you not only have a re-rating for assets in place, of the synergies of assets in place, so doing things more efficiently, that's what everybody knows, but you also get new opportunities. That's what you guys know now. Because you're larger and you can also bid on new exploration opportunities that wouldn't be accessible if you are just an 11 billion company. It's just clear, it's almost arbitrage for an acquisition strategy. So you can see it in financial markets. So, and the thing is, synergies between assets in place is known. But synergies between growth options is actually quite new. But with these strategic frameworks, you can identify them and see how they work. And financial markets recognize them. So that's why you observe like these buy and build strategies in mining. The PVDO of these mining companies is then like a set of strategic growth options and simple options. So strategic growth options mean a path-dependent option, so one option that leads to multiple other opportunities. For instance, they're going to mine in a new commodity or a new area that leading to further simple opportunities along the path, and there are various operating opportunities. You can all value them, so you can identify all these options. If you look at a specific firm, you can actually identify all these options and estimate the value of all these options using option techniques and also their interactions. So how the whole portfolio of option, what the value is worth. In this case, it looked like this. They bought Glencore, then they bought MIM, that's zinc and copper, and then they went into Canada and they went into nickel and copper. And what that company did was sequentially buy smaller companies. They were re-rated on financial markets because of the appreciation of assets in place, being more efficient, and the growth opportunities, use that capital to make new acquisitions in firms or in mines. This is also a practical application. This is a case where you can do an acquisition. First scenario of a scenario firm is just do an acquisition without any advantage. Scenario 2 is an analysis that we made, a strategy analysis, is a preemptive bid. So then you look at the option and you make a scenario where you're the first to make a bid. And scenario 3 I want to talk to you about, it is acquire a minority stake. So acquiring a minority stake, so a minority stake in a company, this is like I told, is that you acquire first 20% of a company, for instance a mining company, and then later on you buy 80% of the company. How does it help you? Or does it help you? Does it benefit you? If you are in a really competitive environment, so at a certain moment all these mining firms observe that being big is valuable, so all these smaller mining firms, they become into a situation with multiple bidders. How does it help to have a minority stake? If you have a minority stake. So you have already 20% of the company. How does it help in a potential subsequent bidding contest to acquire the company?
You can kind of prevent other companies from fully buying it since you already have such a share, and you can influence your own power by the rest.
Yeah, so you have 20%. You can say, I don't sell that, but they can buy 50% and then they have control. So that is true, but not all. Yes?
What about voting power?
Yes, obviously you need 50% to have control. Yes?
By acquiring a minority stake, if they get into a bidding competition and the price is overvalued, then my share value is going to be higher as well. So I gain a lot of, I gain as much as they gain. So it's a win-win for me.
Exactly right. So if you have a minority stake, you can do two things. You can try to buy the next 80% of the company, right? And then you have the company. But if you have rival bidders, and we have all seen in auction situations, price can exceed values, right? So you're hedged. So if the situation arises that prices exceed your value that you want to pay for the company, you can sell your overpriced minority stake of 20% and then gain on that way. So you're actually hedged in two strategies. You can actually switch your strategy. So you're hedged against intense competition. Either you get the company if nobody bids or bids too low. If everybody bids and prices exceed values, you just sell. An excellent strategic way to get into like an industry where there's a lot of competition for deals. And you have industries where there's a lot of competition for deals. And this way, game theory and behavior economics can help you to develop different strategies. Other examples we already saw was buy and build strategies. That are the similar sequential strategies. Venture capital. In venture capital, you don't know. You start with a startup, and hopefully some of you will start a startup sometime. And you don't know yet if you're going to succeed. So what they do is sequentially stage your investments. So it's like a series of options. So after the first stage, if you're successful, you get the next financing. And after the second stage, if you're successful, you get the next financing. If you're unsuccessful, the option is not exercised and you limit losses on the downside. And that way, you get a skewed distribution. And this is how venture capitalists select the real successful ones. And the real successful ones that go for all these financing stages and have a real high payoff, they pay for the losses. So as a venture capitalist, you know for certain that some ventures will fail. Some of your options will not be exercised. So that's how they play the game. And this is the other way around. This was Vendex. KB Vendex, that was traded on the Dutch exchange. It was bought for 2.5 billion. And they did it the other way around. They used different options to sell their parts. So they bought an undervalued company on the financial market and separately sold all the different opportunities, all the different divisions that they had. So they had a division of low-end retail, they sold separately, mid-range retail, luxury warehouse chain. They abandoned real estate and already got a large piece of their initial investments. So you can also see this as like a selection of options. And if you see that then as a selection of options, you get a higher value than the original value on financial markets, where it was only 2.4 billion. So they bought it for 2.4 billion. Then they sold all the real estate, so all the real estate locations in the best cities of the Netherlands. They got 1.5 billion back. So the remaining value was 0.9 billion, and that they easily recouped with the divestment of all these different divisions. They did very well there. These are examples of the paradigms I just explained. So always remember, prices on financial markets can be exceedingly high, but there are techniques to understand them. Thank you for this lecture. Projects are inter-project, but also intertemporal. With a top-down approach, you can estimate the value of the growth opportunities of a firm. Once you estimate the value of the growth opportunities of the firm, please do it yourself. Try to do it. And then conceptually, try to understand it. You cannot value them yourself, but try to understand it. And see for yourself if you can get an opinion about if it's over or undervalued. And in that way, you use the expanded MPV. That was what I have to say today. Thank you very much. I enjoyed it. I will be here for some questions. This is very nice, but not necessary. I will be here to answer your questions if I can help you. I will stay here for questions.
additional content on Coursera that you won't cover in lecture?
Huh?
Do you have additional content on Coursera that you won't cover here?
Now this is more than Coursera. This dominates Coursera.
Oh, okay, so this has more information on it.
Yeah.
Okay, okay.
What you get here is more than Coursera.
Okay, thank you.
What do you mean by like, are they derivatives or?
Options, real options. Ah, you don't know what the real options is. You didn't look at the videos. No. Look at the videos.
Okay, they explain there?
Yeah. Okay, a real option is an